Hi, I'm James West. This is Midas Letter Money coming to you live from the Market One Media interview zone at the Canadian Investment Conference in Vancouver, British Columbia. My next guest is Rick Rule, chairman of Sprott USA, subsidiary of Sprott Inc., trades on the TSX under the symbol SII. Rick, thanks for joining us again.
James, it's always a pleasure. Thank you for having me.
Now, Rick, let's first touch on the mining and the resource sector as a whole, which has been Sprott's bread and butter since day one, more or less. How do you feel about the market going forward?
I'm extremely attracted to this market. This will now be my fifth personal cycle going back to 1971. The same sort of thing from Sprott's point of view. The old truism that day follows night, bear markets beget bull markets is true, but this is particularly attractive. There was a lot of money raised in the last cycle that's been deployed. It's on sale at a discount,
sure,
which I think is a wonderful thing. Providing follow-up money at a discount to what earlier money was raised at is a good thing. But the second thing, and this is really important for your listeners to understand, is that past really is prologue. What we are in right now is a cyclical decline in a secular bull market. The same thing that we had in the middle of the decade of the 70s. Having lived through it once, I remember it, I feel it, and I'm delighted to be living through it again.
Sure. Okay, so how much capital do you have to deploy into this market?
I don't know exactly, but I suspect on balance sheet at Sprott and on balance sheet in long-term affiliates that we control, we have about $1.5 billion cash left to deploy in this market.
Okay, so what do you think has changed in the junior resource sector since the onset of the bear market, and call it mid-2010?
Well, in the first instance, a market that's declined 75% is arithmetically 75% less risky, which people don't seem to understand. The second thing that happened is that this market has begun to attract private equity capital. And private equity is going to be very handy because it's disciplined capital. Private equity looks at things like general and administrative expenses relative to project expenditure. In other words, this business is going to begin to enjoy adult supervision, something it hasn't had for 20 years and desperately needs.
Okay, so would you say that one of the major causes of the bear market, or perhaps the most exacerbating factor, is the irresponsible stewardship of capital?
Absolutely. Irrational investor expectations and the stupid stewardship of capital. I mean, if you think about even the aspirations of the large brokerage firms, they were all bullish on gold at 1800. They're all bearish on gold at 1200.
Sure.
That makes no sense at all. They extrapolate current trends to infinity. All you have to do is take the backside of public perception and have the cash and the courage to stay the trade, and you are going to make money.
Okay, so there's the courage of your convictions in black and white. All right, let's go sector by sector, because it's safe to say that the entire, commodity universe is not marching along in tandem. There's different aspects and demand-supply metrics affecting each and every sector. So let's start off with, let's say, uranium. There's been a great anticipation in print suggesting that there's a uranium bull coming that has yet to materialize. What do you think of that?
Well, James, thank you. You always serve me up very soft pitches, which I love. The last uranium bull market, as you know, I was in very, very, very early. That was the single most spectacular financial event of my career. And the fact that I get to relive that experience again is special for me. Cameco, who knows something about uranium, obviously, says that the industry requires $70 a pound to earn its cost of capital. So it costs them $70 a pound to make a pound of uranium, and they sell it for 28. Now let's assume that you and I were in the hardware business and we bought screws for 70 cents and we sold them for 28 cents. How long could we do that?
I couldn't do it that long.
The truth is that either the price of uranium goes up or the lights go out. Those are the only two choices. I live in the People's Republic of California. We hate uranium, and 14% of our baseload power is from uranium. In California, if the price of uranium doesn't go to $70 over the next 5 years, the lights will go out. Now let's think about which probability is greater, the lights going out or the price going up. I mean, this is really, really, really simple stuff. Will it happen this year or next year? Probably not. But I love questions, James, where the answer has to begin with when, not if. And this is something where the question has to begin with when.
Fascinating. Okay, let's apply that thinking to, say, gold. Is it when, not if?
Not with gold, because the supply side of gold is tricky. Most of the gold that's ever been mined is back in a hole in the ground called a vault. So gold is a faith-based investment. I happen to have the faith. I'm a classic gold bug. When you talk about gold, I like to get away from all the nebulous stuff. I like to look at gold on a fundamental basis versus what I call anti-gold. The savings instrument in the world that seems to have market share are US dollar denominated treasury securities, the benchmark being the US 10-year treasury.
Anti-gold.
Anti-gold, as I call it, yeah. So let's look at the value proposition in anti-gold. The US government guarantees, because they can print, that they're going to pay you 2.6% interest a year for 10 years. Absolutely, positively guarantees it. Now, the problem I have with that is that the basket of goods and services that I buy means that my currency is depreciating by 5% a year. Now, I know CPI inflation is 2.1%, but that excludes food and fuel. It's inconvenient for me because I eat and I drive. And the index also excludes tax. I wouldn't complain about the index if I didn't have to pay the tax. But the idea that my cost of living isn't depreciating by 5% a year in US dollars is completely fallacious. So what that means is that the US government absolutely, positively guarantees me that I'm going to lose 2.4% a year compounded for 10 years. I'm going to give them $100,000 and they're going to give me back $60,000 in purchasing power. Jim Grant calls that return-free risk. So if you look at gold versus anti-gold, that is a guarantee that you're going to lose 40% of your purchasing power over 10 years, I think the choice is very, very, very clear.
Okay, well that would tend to suggest that when, not if, is in fact an inevitable for gold.
And I think that's a very important question. One of the things that's happened to me having been on Earth for 61 years is, ironically, with less time on Earth, I become more patient. If somebody says to me, well, Rick, that could take 5 years. Well, I've done that 12 times before. But the question begins with when, not if.
Okay. So then, is there anything to differentiate silver from gold going forward?
I think there is. I think silver is a little more attractive than gold for two different reasons, maybe three. The first is the incredible imbalance between the futures market and available supply, which my boss, Eric Sprott, talks about very, very, very well. The second thing is that industrial demand for silver continues to increase. And one thing that silver bugs need to understand, and people who don't like silver need to understand too, is that silver is absolutely a critical component in both solar energy, which is growing fairly rapidly, but more importantly as a germicide in water treatment. Retreating water on a global basis requires silver, and lots of silver. And there's nothing in the world that we need more of than water. So silver demand in that sense is very secure. And the third thing is that silver has always been more volatile than gold. I buy personally more gold than silver because I'm more afraid than greedy. But most people are more greedy than they are fearful. And those people should speculate on silver.
Okay, so by that explanation, one would have to conclude that the better trade is silver if one has a tolerance for volatility and has the courage and the cash to stay the trade, as you say. I mean, because we don't see the industrial fundamentals rising in tandem in gold. So, but you're more comfortable with gold?
Because I buy it for different reasons. Okay. I buy gold for catastrophe insurance.
I see. That's,
and
that's scary.
I honestly hope my gold price doesn't go up, but I think it will.
Sure. Okay. Let's look at iron ore. What do you think of that market?
Iron goes lower still. When it rebounds, it's going to be absolutely tremendous. But we've added a lot of capacity in the iron business, and we've added a lot of capacity in places like the Pilbara and Brazil that are low-cost producers. It's going to be very, very, very difficult for the marginal iron producers in northern U.S. and eastern Canada, in Africa. It's going to be very difficult for them to compete with all the new capacity coming on in the Pilbara and all the new capacity coming on in Brazil.
Do you hold any money?
When it turns, I do not. When it turns, it's going to be truly, truly, truly spectacular. But we're going lower before we go higher in iron.
Okay. You got a timeline for when it turns?
I don't.
Okay.
I don't.
That's a smart man who says, I'll predict the future, but just not tell you when it is. Okay, so now let's talk about graphite, which is also a commodity that's sort of generating a lot of buzz and a lot of hype. Does Sprott have any interest in graphite?
Sprott may. We assiduously avoid the flavor of the month. And when graphite was really hot 5 years ago, mercifully we managed to be short 5 or 6 graphite stocks, which worked very well. Whatever the great Canadian buzz is, you can be sure that we will avoid. We are very good, however, at coming to an industry 5 or 6 years after it's been hot and separating the wheat from the chaff. We think we're probably 2 years away from knowing which of the graphite pretenders will become real. We certainly look at the applications that graphite and some of the industrial minerals have on a going forward basis. And looking at their contributions to humanity, we understand the big picture story, but you make money where the rubber hits the road. And it's very difficult right now to segregate the pretenders from the reality in graphite and those other minor metals. The other thing that you need to understand is that those markets are extremely small. And if somebody actually gets it right, they wreck it for everyone else.
Right. So graphite's not actually a commodity in short supply and never really has been, has it?
Graphite is not a market that's as easy to understand as uranium, as an example. It's not as broad a market, or certainly a market that's as easy to understand as something like cotton or oil.
Okay. Now let's talk about the LNG export rush that's going on up and down the coasts of Canada and the United States. I mean, it becomes especially poignant given the new Russia-China arrangement and what would appear to be a solidification of the matrix now defined by East versus West. So we've in Canada got at least 8 major LNG export terminals in the blueprint stage that have not necessarily been permitted yet. We're expecting some kind of decision on a lot of them imminently. How do you see that market playing out for LNG going forward?
Well, what I need to say to my Canadian friends is get the lead out. World LNG prices right now are very, very, very high, and there's so much capacity coming on that they're not going to stay high. Canadians will be lower cost lifters than the United States, even with fracking. But the United States has an enormous competitive advantage over you in terms of their distribution network and their storage network. They become a low-cost supplier because they have such a broad domestic market, ironically. They become much more reliable suppliers. You're going to have to compete in a different fashion, and you're going to compete with Qatar, you're going to compete with Saudi Arabia, you're going to compete with the Northwest Shelf of Australia. You can do it, but you have to do it now. You can finance an LNG project right now, and you'll be able to finance an LNG project right now for the next 3 years for one reason. And that's because Japan shut its nuclear fleet in. When Japan shut its nuclear fleet in, it was forced to generate power from natural gas. They don't produce natural gas, so it had to be liquefied natural gas. The price of gas in the United States is $4.50 a thousand. The price of natural gas in Japan is $18 a thousand. This arbitrage will not last, and Canada has to raise the money that it needs to raise for transportation and liquefaction right now while the price is high. If Canada continues to have this insane bickering, you are going to lose one of the best opportunities for export earnings that this country has ever had.
Okay, let's belabor that point just a little bit because it's one of my favorites. As a resident of the coastline of BC, in fact, an island on the coast that would see 1,600 LNG ships a year passing by, and a substantial conversion in the profile of the coastline, which I have fallen in love with. I mean, I believe that this is the gold, this is the jewel of the West Coast. I don't want to see it turn into LNG export central. I also believe that there are other aspects in the world that threaten the integrity or the viability of these projects going forward. So exactly, get the lead out. But what happens if they don't get the lead out? What happens if, for example, JOGMEC, the Japanese national oil company, is claiming that they will be able to sustain Japan's hydrocarbon energy needs from methane hydrates on the coastal Japan shelf by 2018? What does that do for the demand picture? What is China, who's going to buy all of their gas in a pipeline, which is much cheaper to buy than or intake than LNG? What happens if they amp that up and it supplies their entire needs? There goes 2/3 of the market for LNG.
Well, PetroChina has estimated that Russian and Turkmen supply will be about 12% of Chinese needs. So we can deal with that one fairly easily. The Chinese and the Japanese both are wise to diversify their energy sources. With regards to JOGMEC's claim with regards to the hydrates, I would suggest that suggests that they themselves are subsidizing BC's new growth industry, which is medical marijuana.
Okay,
I think that the probability of that is somewhere between slim and none, and I think slim's out of town. With regards to your own NIMBY attitudes, I understand them personally, but the fact is that your preference for your view is probably something that should be expressed in the market. If you believe that enough, then you should buy the available sites for an LNG plant and shut them down with your own money. The idea that you have the ability to steal other people's money to preserve your point of view is one that I understand, but I have no sympathy for.
Okay, well, we'll stay frenemies on that one, I suppose. Now, you mentioned it, and I wasn't going to bring it up, but I mean, I find it a highly entertaining topic because there is nobody with no opinion about it, and that is the medical marijuana industry that's emerging in Canada. What's your take on that, and does Sprott have any holdings in that?
I can't speak for Sprott as a whole. I try and invest in businesses that I understand, and I have about a 35-year gap in my knowledge with regards to marijuana. I don't know any 16-year-olds anymore, so I don't know how to get any. I'm delighted to see companies in BC in the marijuana business because I'm delighted to see companies involved in businesses that they have direct experience with. Most of the directors of BC companies have no experience with mining whatsoever, and I would suggest that 60 or 70% of them have deep experience with marijuana. Which I think is a very good thing. Whatever the flavor of the month is in the Canadian dealer network, you can be sure it's a scam.
Okay.
That's a guarantee. That doesn't mean that if they raise $1 billion for medical marijuana in BC that one or two good companies won't come out of it.
Right.
But the idea that those companies will defeat Altria or Seagram's or something like that in terms of branded drugs seems to me to be a very poor outcome. That doesn't mean that the story isn't strong enough, that somebody couldn't jitney a 25-cent stock to $2.50. What it means is that it's very unlikely that viable companies will emerge ultimately. Two different questions.
Sure. Okay. Now let's wrap it up and let's talk about, you have a conference coming up in July here in Vancouver. What's the conference all about?
Well, Agora has put on a natural resource conference in Vancouver that's arguably the best retail investor conference with regards to natural resources that exists. It's happened for 16 years. And it happens again, July 22nd through 26th, I think, at the Fairmont Hotel, Vancouver. Sprott is producing it this year. I think the thing that sets it apart from other conferences, like this one, which is, by the way, a very fine conference. I've spoken at Joe Martin conferences for 30 years. This is different. It's a smaller conference. There will be about 500 attendees. It's a paid conference, which means that the loyalty of the conference presenter is to the attendee. There will be 50 exhibitors. But the qualification for an exhibitor is not a check that cashes in a pulse. The qualification for an exhibitor is that they have to have survived a screening by every major speaker there. Attendees at the Agora conference have said for years that from their point of view, exhibitors are content too, they're not advertisers. And Agora has taken the point of view that that's true. So what's really important about this is not just the quality of the speakers, not just the quality of the attendees. They're high quality attendees because they pay to be there, but particularly because the exhibitors have been screened. It doesn't mean that they all work, but it means, first of all, in the case of Sprott, that we own almost every exhibitor there, and that no exhibitor has gotten one bad mark from any senior speaker. It's very important to understand the screening process.
Okay, I think I'll try to get myself a ticket. Let's leave it there, Rick. As usual, a fascinating interview, and I look forward to our next conversation.
James, I will give you a ticket.
Brilliant.
The best possible price, and thank you very much for this opportunity to speak to your audience.
It's my pleasure. My guest today was Rick Brule. Rick is the chairman of Sprott USA, which is a subsidiary of Sprott Inc., trades on the TSX under the symbol SII. My name is James West. This has been another edition of Midas Letter Money, coming to you live from the Market One Media interview zone at the Canadian Investment Conference in Vancouver, British Columbia.